What are the best ways to pay the taxes that you owe when you do a Roth conversion? There's an option that's the most convenient. There's an option that's the most efficient and productive. There's even an out-of-the-box option for you, so make sure you stick around for this video. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees retire better by thinking through their planning ideas of how to implement them to give them the best retirement that they can have. If you want to talk to an advisor, then click right here. So before we talk about how to pay the taxes on a Roth conversion, let's first define and explain what a Roth conversion is. When you have traditional retirement money, meaning you took a tax deduction when you made the contribution, hopefully the account has grown in the meantime, and you'll have to pay taxes whenever you take the distribution. Now, if you want to, you can take some of that traditional money and move it to a Roth account and go ahead and pay the taxes on it today at today's tax rate so that all future growth will be tax-free. Assuming that you play by the two rules. Number one, you must be 59.5 or over when you take the distribution, and you must have had the Roth IRA for at least 5 years. Now, some of the reasons why people would want to do this is that they think taxes are lower now than what they're going to be one day. Some people want to pay taxes on the seed instead of the harvest. So if you go ahead and pay some of the taxes now on your current balance, you won't have to pay taxes on a presumably larger balance later. Now, some people realize that they have deductions for mortgage interest and children in the home and stuff like that. So they want to go ahead and pay the taxes now while they have these deductions, because in retirement, most of these deductions seem to go away. These are some reasons why people would want to do a Roth conversion. Now, just as a note for all the federal employees out there, the TSP does not let you do Roth conversions inside of the TSP. So if this sounds like an idea that you want to implement in your planning, you will have to move your TSP out of the TSP and into an IRA to be able to do this. And so you basically have two opportunities for moving your money out. You must be the age 59.5 or over. If that is true for you, then it doesn't matter if you're still working or if you've retired. If you're over that age, you can move your TSP out into an IRA. Now, the second way is that you've retired. You can move money out when you've retired. So whichever one of these allows you to get the money out of the TSP, you can do that and move it to an IRA and then do a Roth conversion from there. Today's video is talking about the best way to pay the taxes. So now, the most convenient way is to have the taxes withheld from your conversion. So for instance, you may have $50,000 that leaves the traditional balance, and you have $40,000 show up in your Roth account, and you have $10,000 go to the IRS for taxes. So the full amount of the conversion does not show up in the Roth account because the taxes have been withheld. This is the most convenient way. This way works well as long as you're over the age of 59.5, because if you're below the age of 59.5 and you withhold the taxes from the conversion, the IRS will consider that tax portion to be an early distribution and therefore will be penalized with the 10% penalty. You're allowed to do a Roth conversion under the age of 59.5. So please hear me on that. You can do a Roth conversion under the age of 59.5. The distinction here is that you will need to find a different way to pay the tax because you can't withhold the taxes if you're under the age of 59.5. Now, for some of our special provision employees or for others that are retiring prior to the age of 59.5, you can move your TSP out into an IRA to give you the opportunity to do a Roth conversion. But remember, you're under 59.5, so you can't withhold the tax from the Roth conversion. So the way around this, if we go back, instead of doing a $50,000 Roth conversion, you can do a $40,000 Roth conversion, and you have all $40,000 get converted to the Roth account. Then you have to go back to the TSP and do a $10,000 distribution and instruct the TSP to withhold 100% to go to taxes. If you retire at age 55 or over, if you're just a regular FERS employee, or age 50 and over for special provision employees, there is no 10% penalty for distributions from the TSP. So you're allowed to pay the taxes from the TSP, where you're not allowed to pay it from the IRA when you're under the age of 59.5. This also brings up the important point of if you're under the age of 59.5, you may want to move your money out to an IRA, but you don't want to move all of it out to an IRA. You need to leave some in the TSP so that you can take distributions without a penalty, and you may want those distributions to be paying the taxes on your Roth conversions. So you can do a Roth conversion from the IRA, having all of the money go to Roth. You're paying the taxes from the TSP by taking the distribution and having it all go to the IRS. This is something that we help clients with all the time. It is slightly cumbersome, but it avoids the penalty, which makes it worth it. So the first way to pay taxes is the most convenient and easy, and you just have the taxes withheld from the transaction. The second way is to have the taxes paid from the TSP if you're under the age of 59 and a half. Now the next way you can pay taxes is just basically writing a check for it. There are 3 buckets of money that you can store your money in. It could be non-qualified, meaning it's not retirement money and it doesn't qualify for any special treatment. This is your checking account, your savings account. Maybe you've got a Vanguard account that's just got some regular old money in it. The next bucket is traditional money. This is the traditional IRA, traditional TSP. This is the money that we're using to do the Roth conversion. And then you have the Roth account, which is where the money is going that has the tax-free benefits. So you can do a Roth conversion where you take money from the traditional account, you move it to the Roth account, and you don't withhold any taxes from it. And then you can go to your checking account or your non-qualified account or some other just regular old money, and you write a check to the IRS. This is the most efficient way of doing it. If we go back to our example that we started off with, when you're doing a $50,000 Roth conversion, but only $40,000 shows up because $10,000 had to go to taxes, well, this is the most efficient way of doing it. Is you can have the $50,000 Roth conversion, and you have all $50,000 show up in the Roth account, and you're getting more bang for your buck. Now, the $10,000 that's owed for taxes, it can be paid from your non-qualified money. So maybe you've got extra money in your checking account or your savings that's just specifically earmarked for taxes. I haven't really met anybody that has money specifically earmarked for taxes, but we have met people that have a lot of non-qualified money, and this money does not qualify for any tax advantages. So it can be a great source to pay the taxes so that you can Roth convert more money faster. So the benefit of doing this is that it lets you Roth convert more money. Where you can get into trouble is by not withholding the taxes quick enough, and you get the IRS mad at you. So there are some penalties for non-payment or underpayment of your taxes. So straight off the IRS webpage, it says this: you may avoid the underpayment of estimated tax by individual penalties if your filed tax return shows you owe less than $1,000. Well, that's probably not going to be you if you're doing a Roth conversion. The other reason no penalty is if you paid at least 90% of the tax shown on your return for the taxable year, or 100% of the taxes shown on the prior year. So when you do your taxes, if you've already contributed 90% of the taxes owed, then there's no penalty. Or if you've already, kind of paid ahead in advance 100% of the amount of tax you paid last year, then you don't get into trouble. So the great thing about this option is that it doesn't matter how old you are. You can do a Roth conversion at any age because you're paying your own taxes. The traditional money going to Roth is not penalized. You can do that with no penalty. So the problem with withholding money to pay taxes was that when you're underage, but by writing a check yourself, it doesn't matter how old you are, so everybody would be allowed to do this. The benefit of paying your taxes this way is that it allows your Roth conversion to be more effective, more efficient, by getting more of the money actually in the Roth account. The $50,000 example, it got all $50,000 to the Roth account. So the drawback is you got to have cash readily available on hand in order to pay this. So the next way that you can pay taxes on Roth conversion is somewhat nuanced. It won't apply to everyone. Let's say you have an inherited IRA. Someone's passed away, they've left you an IRA. You now have 10 years to get that money out of the IRA under the new rules. So depending on the age of the person that died, that will depend on whether you're forced to take an RMD the first 9 years. But either way, you have a 10-year period to get the money out. You could take yearly distributions, paying taxes on the distributions, to get cash on hand to then pay the Roth conversion taxes. So you cannot Roth convert an inherited IRA. That's key. You can't do that. But you can use the proceeds from a distribution from an inherited IRA to then pay the taxes on your personal Roth IRA conversion. I know this is thinking outside the box, but if you have an inherited IRA, this is a good planning idea that you can use that most people can't use. So if you've watched our channel any, you know that we like Roth conversions and we like preparing in advance by doing tax planning. So there's multiple ways that you can pay the tax. So hopefully you got some value out of our discussion today. This video just scratches the surface on Roth conversions. If you want to see how it's possible to save $1 million in lifetime taxes, then watch this video right here. It's fascinating how much proactive planning can save you. If you want to talk to me about your retirement planning, go to christycapital.com. If you want to see how it's possible to save $1 million in taxes, click right here. I'll see you next time.